The exception to that is minimum wage in the state of California increases January 1st. And so in late December, we will do some wage increases for some of our employees that are in the $13, $14, $15 an hour place.
Right.
So, yeah.
Yeah,
and that's built into the budget.
We were curious. We were wondering if the governor was going to suspend that, just given, again, what employers up and down California, many of them who employ minimum wage employees, and many of the businesses that have been hit the hardest by the closures, you know, small restaurants, small businesses. I thought there would be a reprieve, a deferral of that, but it doesn't appear to be the case.
It's about $1.4 million.
For us?
For us,
yeah.
Yeah.
Now, what I can say is that we are not reducing the compensation of any of our employees. Again, there are many organizations, including the state of California, that will implement actual pay cuts to help fund this very difficult year. I read in the paper this morning that the governor is proposing an across-the-board 10% cut in the wage rate of all state workers. Now, he has to work through the unions to accomplish that, but we are not having to resort to pay cuts to help balance this budget next year. But there will be other things that will affect both labor costs and non-labor costs that are necessary to achieve what I'll call a balanced budget. Now, a balanced budget for us is kind of what I was describing earlier, that you have a positive margin, and then that margin's used to fund debt repayments and capital equipment. This year, with the board's unanimous support, management has proposed that we simply achieve a break-even budget, that we actually budget for just a 0% operating margin, that 100% of our revenue is spent to cover 100% of our expenses. So that's the budget that we'll be presenting to the board on Monday night, is one that reflects a 0% operating margin. Now, even though it's 0%, because of depreciation expense, which for us is about $30 million a year, for all the accountants that might be on the broadcast here, depreciation expense is associated with assets that you've already bought, buildings or equipment. You already paid for them in past years, but you expense them over the life, the useful life of those assets. And so every year, as part of our operating income, we expense $30 million in depreciation expense. So that money will still be left over, even with a 0% operating margin. And it's that $30 million that is used to repay all the debt, and then to still have, maybe, we might be, right now we've been targeting a $16 million capital budget just to reinvest in our infrastructure, our IT equipment, surgery technology, imaging, replacing equipment, and so forth. We probably won't be able to do the full $16 million. We're going to have to do something else. We're also going to have to spread it out through the year so that we don't all rush to spend that capital budget right out of the gate, because our income doesn't come in that way. But at the end of the year, with a 0% operating margin, there essentially is nothing that will be put back into cash reserves. So we will have spent all of it. But that's okay. It is, again, an unimaginable, unprecedented period of time that we're in. I think the senior management team and the board yesterday at the conclusion of our board meeting all kind of characterize, if we can achieve this budget and execute everything we need to do and hit that 0% operating margin, we consider the year successful and a victory.
Yeah.
But it's going to be tough.